goods are up. That's the best number you have in the entire picture. It's up 8.3%. Consumer goods have done extremely well. Non-durables have not done so well. That's a contraction of 3.6%. But consumer goods, as both you economists and Ashu were speaking, have done very well. Now, Sonal, I wanted to, one variable which we don't discuss very often, the NREGA implementation and a whole host of programs that actually this time have seen fairly decent implementation. Of course, we know about the Pay Commission and its award and what it has done to consumer goods. But the NREGA implementation in several states has been exceptional. Do you think, therefore, the downside to this industrial growth may not be so big because perhaps by accident, the previous government has taken care of some aspects of this of rural demand, probably through the Bharat Nirman projects, the Gramin Sadak, a whole host of them, NREGA being the most important, as well the farm loan waiver?
I think so. I mean, ultimately, it's showing up in the IIP numbers. And like I said, I think the non-durables to a large extent, the growth would have been higher except for, certain supply-driven disruptions on the sugar side. So I think, yes, the non-durable side is showing up. The sectoral numbers are showing up. And the PMI numbers we have for April also do suggest that there will be a pickup. And I think the recovery in the initial phases, of course, will be driven by consumption, but I think within consumption, primarily led by government-related spending. And NREGA, pay hikes, etc., are a very big component of that.
I'll just put into perspective why Atsi is repeatedly referring to sugar. In the weights of industrial production, food occupies a very big weight. It is 90.8 in terms of weight. It is beaten only by chemical products, which have 140 number weight. But food products in the month of February contracted by 28%. So clearly sugar was playing a big role, and the fact that a lot of sugar mills did not have enough cane to crush in not just UP but to some extent even in Maharashtra has kind of gone into this. Atsi, therefore, let me come to a question which I would never fail to address when we discuss IIP. How useful are these numbers? I mean, it's disgusting the fact that all these numbers are collected from respondents who were put in place in 1993. We have not changed the list of people who give data into the IIP from 1993, which means there are no cell phones here, there are no laptops, there are no, large part of computers. And, it's not just the end products, it's the plastics that go into it. Chemicals have a 140 weight, but I'm quite sure that wood, which has a weight of 27, probably has been replaced by plastics in a big way. So have been metals and alloys, which have a big weight of 74 and 44. Metal and non-metallic have been replaced by plastics. All this probably are not being reflected. So, Atsi, is this a big number? Should we waste time on it?
I tend to agree with you, Lata, that it is certainly an outdated index in that it's not capturing a lot of the things that constitute industrial output in India today. So in that sense, I agree with you that it's outdated. It needs to be re-looked at. And we keep hearing that that's going to happen. We've been hearing it for a while now. And I think it will happen over time. In the meantime, should we waste time on it? I actually think we should spend a moment looking at it because the trends that the IIP reveals tend to be broadly in line with what we're experiencing in the economy. So when the IIP is wildly positive, you tend to see the GDP growth in general is moving well, wages, income, everything is going very well. When IIP is negative, as it is today, you tend to see that economic outlook itself is quite poor. So the trend that it reveals is, I think, on the money, even if the details are not.
Right, Atsi, just before I come to you, just let's take a look at the market. The market's a little obsessed with the bigger event, which is what the election is going to say. So IIP, I'm sure, is part of some grey cell right at the back of the head. It's not really doing much right now. So actually, the market's kind of picked up. You got about 1/3 on the Sensex. Advanced decline still remains weak. Volumes are low. But certainly, if you're looking from a cause and effect, the IIP numbers have just been given a pass right now. In another week, it would have been different. But today, looking very different. Atsi, let me just ask you this question from the perspective of, let's take electricity. Do you believe the IIP numbers can be lumpy because we're still pretty much, if I can use the word, in a growth stage? So suddenly you add 500 megawatts somewhere, then you add another 2,000 megawatts somewhere. So it just kind of shows up in one particular month, and then we do a month-of-month comparison. So do you believe we can see lumpy IIP numbers? My second question relates to consumer goods. While the rest of us were struggling, the central governments and the state governments were doling out a nice amount of money. So there was a lot of spending power. Do you believe that's a one-time event, or will it continue? So perhaps if you could comment both on electricity and on consumer goods.
Sure. The short answer to your first question, can IIP numbers, particularly as it pertains to electricity, be lumpy? Absolutely. Yes is the answer. And I think that's what we've been seeing, that you've seen supply come on stream somewhere, you've seen supply constraints removed somewhere, and so on a year-on-year basis or on a month-on-month basis, the electricity output looks very good. And we might see that 6 months from now, on a year-on-year basis, it doesn't look as good because the base has already gone up. So there I agree with you. In terms of government spending and whether that is actually being reflected in the current consumer durables numbers at least, absolutely. It's been our belief at Reliance Equities that, in between October and now, what really kept the bottom solid of the Indian economy was government spending, and you're seeing that in the form of NREGA that Lata mentioned, the farm loan waiver, the pay commission hike. All of that is absolutely playing out. What we expect to see over the next few months is the other things that have been happening. So first is you've got the multiplier going by government spending itself, and now you need to see private sector demand take hold. That will take hold, A, as the employment outlook seems less bad than it did a couple of months ago,
right.
And 2, as interest rates come off. So we've been seeing that happening, and 3, of course, is prices. If they remain at current levels or even lower,
right.
Then you'll see consumption demand go back up.
Atsi, just hold that thought. So I'm just going to get one last question into you. What do you think the Reserve Bank of India governor is saying? Because on the way down, it's much easier to keep cutting the benchmark. He tries to increase it by 0.5%, and the world goes up in arms. What does he do here? I mean, rock in a hard place. What do you think he's going to do next?
I think, the last rate cut, or, the last rate cuts are always the most difficult to predict. We are expecting one more rate cut sometime after the election by 25 basis points. But overall, the rate cutting cycle is coming to an end. I think, the focus clearly from the RBI's perspective is moving away from pure policy actions, rate actions, to more sort of balance sheet expansion, accommodating the government borrowing program. So that change should continue.
Yeah, so liquidity infusions is
Absolutely.
what we are going to see. Sonal, Atsi, thank you very much for joining us with your thoughts. I think